Good afternoon, guys. This is Kobus from Cape Town. I'm doing a webinar for George and Global Forex Institute. I'm doing one lesson, the difference between a head and shoulder pattern and a King's Crown reversal pattern. There was a request on the room to show or to ask the guys what is the percentage winning ratio of a head and shoulder pattern, where to enter and where to exit, and what target we have. I'm going to show it everything in this webinar, and I will show you guys why I use it only as a trend reversal pattern to show that the trend has reversed, where I can rather be starting to sell, and why I rather use the King's Crown reversal pattern to trade. The risk reward is one thing, but I will show everything for you now. Clearly you can see this is a head and shoulder pattern. This is quite easy. We've got the left shoulder, we've got the head there, and we've got the right shoulder. Now remember, this is an uptrend. This is an uptrend. We came to the support. This support held up. I'm going to put in that red line there. That support didn't break. Remember, the close of a candle is very important. It went through the support, yes, but it came back. So that support held up. So in all technical views, this trend is still up. Now most of the guys wants to sell the right shoulder, because this is a head and shoulder. This is the left, this is the head, and this is the right shoulder. We're going to sell it. There's no reason that the market should go down from there. Why? Because the support is still intact. We're still in an uptrend. The rules of the head and shoulder is that you sell the neckline. Now this neckline is horizontal. Sometimes it's Q, or from up to down, or down to up. It doesn't matter. You sell only the neckline, because then is the support broken. Only then. So our short should be here. So that short should be on, let's make it 15,000, and your stop should be above that head high, and that's 825. So that's already 825 per stop, which is too big for me. I don't know how you guys trade. I can't trade it. And the other thing is about the head and shoulder rules. Remember, each pattern's got its rules, and you got to stick to the rules. Is that you only go to the reward of the neckline to the head. The same distance is your target. So you only target down here. So if this is an 800 pip stop, you know exactly this is an 800 pip limit. So why should you go for a risk reward of 1 to 1? That's not very good. Yes, the trade went and paid us. This was actually very nice. Remember that past support becomes resistance in the future. Look at that. That was the second signal that we should go short with this pair. The nice entry here is that your stop should only be above that high, because that's your last high. We're only in a downtrend again here. So that high you can sell at let's say 5,000 again, and you only sit here with a 560. But that's only 1 to 1.2 maybe. So the risk reward of a head and shoulder pattern is not so rewarding for me. Most of the guys wants to sell that right shoulder there, and I'm going to tell you now why it doesn't work. If you look at this inverse head and shoulder, let's say this is an inverse head and shoulder, and let's say we didn't know what happened after that yellow box there. Alright, here's the market. Mr. Trader sits here. I see the downtrend. Oh, this is nice. This is a left shoulder. And yes, this is the head. And here the market comes down. I'm going to buy here because this is an inverse head and shoulder. I want to buy that. Guys, this is not the rules of a head and shoulder. You can't buy that right tip. That resistance in this case didn't break yet. So in all due respect, this is still a bear market. And look what happened after we bought there, and we think that the market is now going up. We're going to break that, and we're going up. We're going to make some money now. Our stops are below this head, because this is a head and shoulder. We're going to buy the right shoulder with this inverse, and look what happened. It just took us out. That spike took most of the traders out, and I believe still that is why we got the spin bar, and because most of the stops went bankrupt here, and the market rallied from there. But Mr. Trader is sitting there because he can't stay with the rules of head and shoulder, only to buy the break of the neckline and make money. The analysis was maybe correct, lucky it was correct, but we took out the stops there. Alright, so that's basically a head and shoulder pattern. Why I don't like it, I don't want to buy the right shoulder if the resistance didn't break with the inverse, and I don't want to sell the right shoulder here if the support didn't break. That's very important. Let's go to the euro yen yesterday, and I'm going to show you the difference between a head and shoulder and a king's crown. Now, a king's crown is a trend reversal pattern, just the same as a head and shoulder. They look the same, but there's certain specifics with a king's crown that will make it much more effective risk reward ratio as well. You can write this down, rule number 1 and 2 of a king's crown. First, you take out resistance and the trend line. I'm working with the inverse, yes, I'm working with resistance. You will see I make lower lows down here, lower lows, there's my trend line over that highs, lower low, right. Look at that resistance there. I broke the trend line, alert number 1, and I take out the resistance, alert number 2. So now I know if the resistance is broken, we're already making in this market higher highs. So that is a sign of a bull market, higher highs and higher lows. And this works very well if you use your Fibonacci tool. If you take this neckline of the left shoulder to the head, your right shoulder should be on the Fibonacci extension of a 127% or the 1318%. So let's test that. Do this low. You can see exactly as the 138.2% the market turned. So one took out resistance, we're in an uptrend because we broke the trend line as well. We went to the 138.2%. If it goes past that, I'm reluctant to trade it. I like it between the 127 and the 38.2%. Right, now the market comes down, I'm looking to buy the market. And I'm looking to buy the right shoulder. And why will I buy the right shoulder here but not with the king's crown? Because my resistance got taken out. We're not in a downtrend anymore, we're in an uptrend. So if we're in an uptrend or we determine an uptrend, we're going to buy the right shoulder. Alright, and the rules of thumb is the following. You buy the 618%. You see on that 618%, I always put it 2 pips or 5 pips above. That was 135.23. Let's make it you bought at 135.30, and your stops are below this low and 134. So that's 130 pip stop. That's much better than to buy up here. You already can buy here because the trend changed. Resistance got broken, trend line got broken, buy with a pullback. So what do we go for? What is our target? From that high to that low, we got a 618% bounce here. We go to the 618 and we target 138.70. So that's a 350 pip reward against 130 pip risk. Much better than a normal head and shoulder pattern. This is a king's crown. Obviously you get it in a normal upswing trend reversal where you will sell the right shoulder. So I hope you guys learned something. I didn't even bring candle formations. I didn't bring any indicators, oscillators. I just used price action and Fibonacci to determine if the market turned, when it turns, when I will buy with a retracement. Let's look at the euro yen over the next few days. We're already 150 pips up here. We're targeting that 131.618% there. If you pass this high, you guys can move in the stop closer to just below this low. So let's see. I hope this trade works out. I hope you guys learned something. George, thank you very much for the opportunity to do this webinar on behalf of Global Forex Institute. And I hope you see you guys in Cape Town. The guys that get this will be in Cape Town soon. Thank you very much. Cheers.